Namaskar. Today session 26 we will be discussing about cross listing of shares and depository receipt. Here we will discuss how the financial sector liberalization in India and many other developing countries allow the domestic company to cross list their share in different exchanges all over the world. We will also discuss the process of development of GDR, that is Global Depository Receipt, American Depository Receipt, and also we will discuss how the cross listing has increased the valuation of the company, what way the company has got the benefit from the cross listing of shares. We will also discuss how the investor have try to expose or try to get the benefit of cross listing of share through to different kind of arbitrage opportunity. Before going to discuss about cross listing of share, we should understand here the meaning of cross listing. Cross listing means the domestic company shares or equity is listed in the domestic company share markets, that is equity market of domestic company, and also at the same time same shares are listed in other stock exchange in a different countries, like the Infosys share listed in India NSE and also listed in Nasdaq. Similarly, ICICI Bank share listed in NSE, also listed in NYSE, that is New York Stock Exchange. These are cross listing of shares. Cross listing of share provides some opportunity, some challenges to companies and investors. We will discuss in detail about the cross listing of shares. At the same time, we will also try to do some problems how the cross listing of share has created arbitrage opportunity for investors. Before going to discuss about cross listing of shares, you should understand what are the sources of capital. When the MNC multinational company are not only sourcing their raw materials or the product across the world, but also source their capital across the world. They try to get the capital wherever it is cheap and less risk. Similarly, over the years when the financial sector developed, it is possible for the MNC multinational company to go to migrate from one country to another country and source their capital. The greater interaction of among the financial market has enabled company to access global market. At the same time, increased globalization has allowed smaller company to raise capital in the international market also. The MNC earlier they were doing it, now it is possible on the part of the small company to also source their capital from different countries. This is only possible because the equity market or the financial sector all over the world has developed because of reform measure initiated by different countries. Companies are raising both debt and equity capital from the global financial market. Debt capital, at the same time equity capital also they are sourcing from different countries. Debt capital little bit less risky and less stringent than compared to equity capital, which requires different kind of what is called stringent regulation for the disclosure norm and for listing purpose. Similarly, investor appetite over the year has increased. Investors are now inclined to take more risks. They inclined to invest in different companies share and also inclined to migrate from one country to another country for investing their surplus resources. Recent years, cross listing of shares through depository receipt have become common practice. The depository receipts, underlying the depository there is equity shares, and depository receipt act as a debt instrument. However, it gets the value from the valuation of the equity. So, cross listing indicates that a company lists its shares in foreign stock exchanges besides listing its share in domestic exchanges. For example, as I mentioned earlier, investor from US can invest in Infosys equity share as Infosys share listed in Nasdaq. Similarly, investors can also invest ICICI Bank share since ICICI Bank share is listed in NYSE. So, that is New York Stock Exchange. So, cross listing provides some kind of benefits not only for the investor, but also for the company. The company get good valuation for the their own company. At the same time, they raise resources. Investor gets investment opportunity in good company. So, cross listing is a win-win game for both investor side and also for the company side. So, when I mention here the companies, because of the financial sector reform, they are now in a position to source their capital from different countries. At the same time, the financial sector reform measure has increased the risk appetite of the investor. They wanted to now invest in all different countries, different company by reducing their unsystematic risks or systematic risks both. So, here you have to understand the source of capital. When I mention here, the source is both debt and equity, and both debt and equity are cross listed in different exchanges, and companies small or big, they are a small or big company or are raising resources by listing their debt and equity across the globe in different market wherever it is possible to raise resources. So, when depository receipt, as I mentioned earlier, depository receipt is a just kind, it is in the form of a debt instrument, where the domestic company try to create a debt instrument by keeping some kind of equity shares of the company in the and issuing debt type of receipt, which will be listed and traded across the globe. When I mention here depository receipt, to understand there are two different kind of depository receipt. One is called ADR, that is American Depository Receipt, another is called JDR or Global Depository Receipt. Both the global depositories and American deposits, only difference is here. In case of American Depository Receipt, it is listed in America, that is USA, and global depository receipt can be listed in any country. JDRs are primarily issued and traded in London and Luxembourg stock exchanges, and these are instruments where the underlying asset is equity on which the depository receipts are designed. Depository receipts, when I mention here, are negotiable receipt of security issued by the foreign company, but listed and traded in domestic stock exchanges denominated in the home currency of domestic country. So, depository receipts are negotiable instrument, that is negotiable means it can be exchanged from one hand to another hand with the right for selling it. That depository receipts are listed and traded in home currency of exchange where it is listed, and it is also the depository receipts are in the form of a specific company shares, and shares are underlying instrument on which the depository receipts are designed. When in a DR or depository receipt, the company declares the dividend in its home currency, that this dividend is converted into home currency of the DR investor. Suppose Infosys depository receipts, that Infosys company are listed in India, listed and it is cross listed in Nasdaq. So, when Infosys declare a dividend, it pay dividend in rupee Indian INR. However, there is organization which take care that the DR of the Infosys company take the dividend in INR, convert it into US dollar and pay to the US dollar investor in dollar term. So, depository receipt, the home country, home currency, that is the Infosys has nothing to do with the appreciation depreciation of dollar or rupee or foreign exchange risks. That is the depository receipt organization or the DR, who will be discussing about the same thing. DR take care the risks of the foreign exchange. Depository receipt, as I mentioned, it is a underlying assets or equity upon which that deposit receipt created, and deposit receipts are listed either in NASDAQ or NYSE or Luxembourg or London and traded, and for investor abroad they purchase the deposit receipt and get the dividend, what is dividend in the form of their own currency. So, deposit receipt is a source of income, source of what is called a negotiable instrument, a source of investment opportunity. Since it is negotiable, it can be exchanged from one hand to another hand, and the rights are continuing with the receivers. When I mention the cross listing of share, the deposit receipts has number of benefits and also opportunity. The benefits and opportunity, why the company issue deposit receipt, we have to understand that. What are the benefits or opportunity the companies are getting by issuing DR? When I mention the DR, it is a depository receipt here. Lack of foreign exchange to expand business. Prior to reform measure, foreign companies were getting foreign currency by in the form of debt instrument. However, the currency they are getting because it was affected because of the domestic country risks, because India prior to reform the rating, sovereign rating was quite low. No abroad company were interested to provide foreign currency loan to the domestic company. However, domestic companies are good, but the sovereign rating reduces the overall position of the company. The foreign company get the domestic companies were getting the benefits of the foreign exchange only when they the country liberalize the foreign exchange market. The low or negative rating of the domestic economy created problem for the company which are good and they are in their own country. Then the companies were, despite being good, fundamentals are good, they are good company in the form of potential to expand their business. However, because of the domestic economic crisis or domestic economy problem, their lack of sovereign rating, they were not getting proper valuation of the company for their company. Low investor base, domestic economy like emerging market, investor appetite is not good as compared to developed country. So, low investor base also not possible for them to raise capital significantly from the domestic market. There are stringent guidelines to go abroad and issue the shares. There are stringent guidelines. The guideline in the form of capital account convertibility, the guideline in the form of converting the balance sheet into abroad country balance sheet, their guideline in the form of observing the foreign stock exchange listing process. So, these guidelines were very stringent and there was not possible on the part of domestic company to abide by the guideline and issue shares in domestic market. Then if they issue share also, there is a foreign currency risk. The foreign currency because they have to pay dividend in the foreign currency and any fluctuation in exchange rate create foreign currency risks. Similarly, payment of dividend in forex, it was quite difficult for them. They cannot pay foreign currency dividend because foreign currency, if they are raising resources in foreign currency, if the outflow in the form of foreign currency, it will create problem for them. Then also abroad investors supposed to know about the company, abroad investors supposed to get a grievances for abroad for their equity, for their any kind of problem. So, abroad investors may not interested to invest the company because they do not know about the company. Similarly, the grievances in the of abroad investor getting it very difficult, resolving it also further difficult. These are the some kind of risks for domestic company to divert the convert their equity into foreign currency equity and list directly in stock exchange. It is not possible for them domestic company to directly list in stock exchange. That should be some indirect way of listing the company share and getting resources in foreign currency. This indirect way provided by the DR or depository receipt. So, what is the depository receipt? We have to understand the mechanism of cross listing or depository receipt. There are some point silent features of depository receipts. The features are here. DR or depository receipt represent ownership of equity in foreign company. When a company issue DR, it is nothing but depository receipt represent ownership equity shares in foreign company. These shares are issued against ordinary share held in custody in the issuer's company home market. The Infosys issue DR, the underlying asset is Infosys company equity on against ordinary share of the Infosys company, on it the DR are issued. There is a DR ratio, because how many domestic company, how many equity of domestic company equivalent to 1 DR, what is called DR ratio. DR ratio is nothing but each depository share issued represent a certain number of underlying shares, ordinary shares held in custody in the issuer's home market. So, Infosys share 1:2. In case of Infosys, ADR ICICI Bank is 1:2. So, 2 domestic company share is equivalent to 1 DR. This is called DR ratio. DR certificate resembling an ordinary share certificate, one that equity share gathered and converted into DR as per the DR ratio. The DR certificate issued by the depository institution, and DR certificate is nothing but a negotiable instrument. It is ordinary share certificate and contain general term and condition of which is applicable to DR holder. DR holder get the certificate and get the normal what is called that guideline, how to sell it, how to purchase it, how to negotiate about the share, the DR, how many shares domestic company shares are there with the DR, and DR certificate resembles what is called ordinary equity share certificate. When I mention here DR ratio, DR certificate, these are the terminology associated with the DR receipt. So, also how the trading takes place DR represent underlying assets. What is asset is your equity, and number of equity, how many numbers of equity ordinary shares of the company equivalent to 1 DR, it is a DR ratio, and all DRs are listed and traded in abroad foreign stock exchange. So, trading process, DRs can be listed on a major exchange, any exchange of the world. DR may also be utilized and trade in over the counter market. It is a OTC product, or may be privately placed with a qualified institutional buyer. DR may be a privately placed shares, DR may be a listed company, listed share, DR may be OTC product, over the counter product. How the settlement take place? DR trade in and settle in accordance with the market practice, and the DR settlement take place as per the settlement of the stock exchanges. When DRs are sold, DR holder get the payments in the form of foreign currency. The DRs represent some kind of ordinary shares. The ordinary share will be sold in the domestic market as per the market price. The market price will be converted into domestic foreign currency, and foreign currency will be given to the DR holder, which actually held be there in a foreign country. The currency risks, the currency you are converting DR into domestic currency, domestic home currency, and home currency again into foreign currency involves some kind of currency risks. The currency risks absorbed by the DR institution, what is called a representative company, which actually issue the DR certificate that take care the foreign currency risks. Although DR denomination match the currency of the market in which they trade, the currency risk associated with the investment in foreign company is not eliminated. The foreign company which actually represent the as a DR issuing company, they observe the foreign currency risks. When I mention the cross listing of deposit said, what kind of benefit the company gets? The company which issued the DR creates burdens and diversify the investor base to include investor in other capital market. The domestic company creates a different kind of investor, which are foreign investors. So, their domestic equity listed in domestic market, at the same time their ADR and GDR listed in abroad. So, they get two different kind of investors. These two different investors create valuation for the company, and generally abroad investor get the benefit, generally have the more appetite for risk, they create good valuation for the domestic company. The DR also enhance the visibility and global presence of company because of the diversified investor base, and also the customers and customers of the company, the consumer of the company also get benefit out of the valuation of the company. It develops what is called more liquid, increase the liquidity of the company, because new investor has come, the investor buy and sell their shares. So, there will be more liquidity in the domestic equity of the company. Develops the increased research coverage of the company, because now shares has been listed in abroad, cross listings are there. So, researcher, the equity market researcher try to cover the company, try to create more information, try to get more information about the company. The more information and research coverage of the company will increase the valuation of the company. So, since the company is more market oriented, so the company is more disciplined in nature, because the company try to not to do such kind of activity, such kind of policy measure which can affect negatively about the company. So, always after the cross listing, company are more disciplined in nature, and they try to communicate with the shareholders globally through different mass media communication and also through policy measures. The enable price parity of the global peers, because they when they list in a cross listed their share, they try to increase the visibility of the company, try to perform with the peers of the abroad. So, they always try to do such kind of activity which increase the valuation of the company, offers new avenue, new venue for raising equity capital, because now they are cross listed, they can go for more dilution of the equity, they will get more good valuation for the company, further dilution of the equity, they will get more equity capital, more premium for their own domestic shares. Then since their activity are abroad, the abroad stock exchange they are listed now, it facilitates the merger acquisition activity, creating a desirable stock swap acquisition currency. Suppose the company try to get some kind of merger or acquisition abroad company, their valuation, since they are listed abroad, they will get good kind of swap conversion. The conversion of domestic company share into abroad company share, they will get a good stock swap. The acquisition of currency or the valuation of the company increase the merger acquisition process, and the merger acquisition process, because of the cross listing, they get good valuation of the own company shares. There are some kind of risks for the company. The risks are also there. It is not that there will be only benefit out of the stock listing or cross listing of share in different stock exchanges. There are many issues are there. The costs are huge. The costs are more in form of what is called nominal or the pecuniary cost, maybe in the form of also cost in the form of what is controlling aspect. The risks, the costs are involved here, company have to pay depository fee, because they are issuing depository certificate, they have to pay depository fee, listing fee, audit fee. They are the cost associated with the DR issue. They also have to pay what is called entry fee, an annual fee to exchange where DR are listed. The entry, because they are listing in a other country share market, so they have to pay entry fee. They also pay annual fee for trading of their DR certificates. Company have to prepare their annual report as per the global gap, that is the general agreement. They have to pay, they have to convert their balance sheet and prepare the balance sheet as per the stock exchange requirements, the foreign country stock exchange requirement. So, that is audit fee, or the converting the balance sheet into foreign country balance sheet also involves some kind of cost. This cost can be sustained specifically for an Indian company where DR costs are denominated in USD, because this cost will be substantial. Because why substantial? Because audit fee, depository fee, listing fee, conversion of balance sheet fee, these have to company has to pay in foreign currency, and these are substantial for a Indian company. Then there are many other issues, these are pecuniary issues I told you, where involves a foreign currency. There are many non pecuniary issues also there, which are also in the form of cost for the company. Exchanger, since the company has to repatriate the dividend repatriation, though it is not involved in foreign currency, however, exchange rate risks also affect the company. There may be some withholding taxes with the foreign country, double tax agreements are not there, then company has to bear the withholding taxes. There are ADR, GDRs are inherently illiquid, as proportion of ADR, GDRs are less compared to the total outstanding equity shares of the company. So, generally we are assuming that the ADR, GDR will be traded in foreign currency, foreign exchange market, foreign country exchange. But however, ADR, GDRs we have seen over the period, ADR, GDRs are less liquid compared to the liquidity in domestic market. There are, since foreign investors are purchasing the ADR, GDR, that company is exposed to foreign currency volatility. The company may be exposed to what is called some kind of market oriented valuation of the company. The company also exposed to what is called merger acquisition process. The company may be despite ADR, GDRs do not have voting share, however, the company may be influenced by the investor in day to day decision making process, in directly or indirectly. So, there are some other costs also involved, which are non pecuniary in nature. So, the company has a pecuniary cost, the cost of depository fee, cost of listing fee, cost of audit fee, cost of conversion of balance sheet fee, cost of foreign currency risks. There are non pecuniary receipt, which is market oriented valuation of the company, more prone to merger acquisition. So, these are the non pecuniary activity associated with the DR issue. So, what are the mechanism of DR issue? When you discuss about DR, DR provide a cross listing of shares, domestic company share in abroad market. What is the mechanics of DR issue? Domestic market, in the domestic market shares, domestic shares are surrendered to depository company. There is a depository company. The depository company gets the domestic equity shares. The depository company decides the DR ratio. After getting the domestic equity, the company decides the DR ratio, that is how many domestic company equity will be equivalent to one DR certificate. After converting the domestic equity into DR certificate, the depository receipt company issue DR certificate to investor in US. Suppose it US, the company is getting listed in US. The US investor purchased the DR certificate, and this depository company lists the DR in US bond market. Dividend would be transferred to depository company in domestic currency, and the abroad investor gets after purchasing DR get the interest or dividend from the depository company in the form of US dollar. So, that the process is here, you have to understand the process here. Here two different systems are involved. Here first thing you have to understand, here Infosys company, suppose Infi surrender 10,000 Infosys shares, 10,000 Infosys shares to a DR, depository receipt company, DR company. After DR company got 10,000 shares of Infosys, and DR company convert the domestic Infi share into DR certificate. The DR certificate, suppose they have to decide what is called DR ratio, what is called how many domestic companies share, domestic equity share equivalent to 1 DR. So, suppose DR ratio fixed, then DR ratio decided by the DR ratio 1:2, means for every 2 domestic shares there will be 1 DR certificate. So, after deciding the DR ratio is 1:2. 2 domestic company, 2 domestic shares of Infosys company equivalent to 1 DR certificate, then issue what is called DR certificate. DR certificate, that is here DR certificate will be 5,000 DR certificate. After DR certificate issued, the DR will be listed in, suppose in Infosys listed in NASDAQ stock exchange, it will be listed, and who will purchase? All 5,000 DR deposit receipt will be purchased by US investor. US investor, after purchasing the shares, that is underlying DR is equity. So, 5,000 DR, whenever Infosys issued the dividend, Infosys issued dividend. So, dividend, suppose dividend will be transferred to DR in the form of INR. So, the DR company, deposit receipt company, convert this DR INR into US dollar, and US dollar will be transferred to then here the holder of the Infosys DR, they will get the, here the foreign exchange risk absorbed by the DR company, DR deposit receipt company. This is the mechanism of converting the domestic equity into DR certificate. There are many kinds of DR certificates, you have to understand there. What is the DR? DR can be 2 types, what is called sponsored, unsponsored DR, depending upon the company activity involved in issuing the DR. The company has to involve, company may involve, may not involve in DR issue. If they involve or may not involve, the involvement part of the company decide whether the DR is sponsored DR or unsponsored DR. In case of sponsored DR, DRs are issued by the active participation of the company. The company participates in the issuing of the DR. The issuing company and the depositories enter into a depository agreement before the DRs are issued. The depository company and the issuing company, the issuing of the company which actually issued the DR, they together sign a agreement, what is called depository agreement. The depository receives the dividend in the foreign company's home currency on behalf of the DR investor, and convert the dividend into investor home currency and make payment to the DR holder. The domestic company actively involved in the issuing of DR, the DR institution which actually issued the DR certificate, get the dividend from the domestic company in the form of domestic currency, convert into investor company country home currency and pay to the DR holder. The depositories also manage the DR holder to exercise voting right. So, the depository institution get the total voting of the DR holders and provide the voting right to the domestic company which is there in India. For all other practical purpose, the depository acts as a front in the front office for the DR issuing foreign company. The DR issuing foreign company. So, here the sponsored DR, the domestic company actively participate in the DR issue. Though they engage a DR company for issuing certificate, they try to manage the DR issue with the actively participating with the DR institution. But in case of unsponsored DR, the unsponsored DRs are issued by one or more depository institution. There may not be any formal agreement with the company. The company, suppose Infosys issued here, there may not be a formal agreement with the Infosys company. Many DR institutions, they convert the domestic company equity and convert and in the form of DR issue. But here the unsponsored DR, there may not be any agreement with the domestic company. The DR institution, they themselves convert the domestic company equity and convert into a DR certificate. For unsponsored DR, depositories are not required to take permission or even inform the foreign company before issuing unsponsored DR. The unsponsored DR, there is no formal agreement between the company against which share the DRs are issued. The company may not know also, but the depository institution can create some kind of DR. So, it is unsponsored DR, there is no activity of the company against which share DR are issued. In a unsponsored DR, the depository buys the shares of foreign company and deposits the share into a custodian, then it issues the DR with which investor can invest. Hence, there could be multiple unsponsored DR, any company, any depository institution can create DR for any companies. So, dividend received by the depositor may vary significantly. Both depository may charge different service fee. So, there may not be any kind of formal agreement with the company against which share the DRs are issued. So, in case of unsponsored DR, many DR will be there, many depository company will be there. However, the formal agreement with the company against which share a DR issued may not be there. So, there is no activity on the part of the company against which the shares are the ADR or GDRs are issued. So, there are many kinds of levels of DR, level 1, level 2, level 3 and privately pressed DRs are there, depository receipts are there. In case of sponsored level 1 depository receipt program is the easiest way to list the DR and it is the fastest growing segment among all sponsored DR program all over the world. Level 1 DR is a sponsored level 1 DR, generally all companies are issuing their DR deposit receipt on level 1 sponsored DR. In a level 1 DR, the company cannot raise any fund by issuing new security as DR. There is no further issuance of share, it is not a way of raising money, only a way of valuation of the company. That is the only reason the companies are issuing level 1 sponsored DR. Company issuing level 1 DR do not have to abide by the listing agreement, listing requirement of the regulatory body. These DR normally trade in OTC over the counter market and level 1 DRs are subjecting to EG or no listing requirement. In fact, level 1 ADR does not require the issuing company to recast its accounting statement as per the US GAAP. There is no requirement. Level 1 sponsored DR very easy way to easy way to list the company in a broad market or cross list the company in a broad market. there is no listing guideline for that, there is no need of recasting the balance sheet into as per the US GAAP arrangement, and it is a DR level 1 DRs are over the counter that and it is traded as per the over the counter. So, it is very easiest way to issue the shares. But level 2 and level 3 sponsored ADR requires the exchange listed shares. They need to be listed in cross listed their share in the abroad market. In level 3 program, the company can list the DR in foreign stock exchange as well as raise the money from the abroad. The both level 2 and level 3 are required for the company to abide by the all listing or reporting guideline as per the requirement of the stock exchanges. Level 2 DR program are easier than the level 3 DR program. So, you have to understand level 1 is level 1 sponsored DR in the form of a what is called getting valuation for the company. Level 2 and level 3 sponsored DR or JDR in the form of raising capital and requirement of listing of the company in foreign currency, in foreign exchange, foreign country stock exchanges. Level 2 and level 3 are difficult, level 1 are easiest way to convert the domestic equity into DR receipt. When you understand this level 1, level 2, level 3 DR process, there are many company you can see in Indian context issued the DR certificate. You can see Dr. Reddy's the listed in NYSE is a level 3 DR sponsored DR, and the domestic share ratio, the DR ratio is 1:1. It listed in 2001. Similarly, Grasim, HDFC Bank, ICICI Bank, India Hospital, these are the Infosys company. All these company have over the year convert their domestic equity into DR, and also some of them raise shares, some of them raise the capital from the market, some of them only listed their share in cross listed their share for valuation purpose. So, we have some extent some guidelines have been abided by this company while issuing converting their domestic equity into DR type of depository receipt. Here you can see all the company I have gathered the data from the India Stat. You can see go through that and see how the company over the year issue level 1, level 2, level 3 sponsored unsponsored DR type, all are sponsored DR. There is no unsponsored DR is rarely available in Indian context, all are sponsored DR, and they have issued the convert the domestic equity primarily to raise capital, and also some of them also have gone for only the cross listing to get the good benefit of valuation purpose. So, if you see there are some Indian company JDR issue over the year, how they have issued the JDR type, some companies are also there. Here you can see the concept what is called arbitrage opportunity and fungibility. In the prior to 19 what is called understanding the arbitrage opportunity in DR issue, to understand the process of arbitrage here. The process of arbitrage, you have to, as I mentioned earlier, DRs are depository certificate in the form of a debt instrument, but however, the underlying in DRs are domestic equity. So, all DRs get their value from the share market equity valuation of the company in the domestic market. So, it may happen there DR which are cross listed in abroad and the domestic equity which are listed in domestic market may have two different kind of valuation. The two different kind of valuation may give rise to arbitrage opportunity. So, but arbitrage opportunity initially it was available to in foreign investor, and because of the fungibility reason. However, after some years when Government of India and the SEBI liberalized the fungibility guideline, it is available both to the domestic investor and foreign investor. Before going to the arbitrage opportunity, you have to understand domestic equity denominated in Indian rupee and DRs are in foreign currency. So, trade in different market gives rise to arbitrage opportunity. The domestic equity in foreign domestic company in listed in domestic market and their valuation they get as per the valuation of the investor of domestic market. DRs, no doubt the underlying is domestic equity, but it is denominated in foreign currency and listed in a foreign market, and investors are also different, investors are foreigner. So, investor perception changes, there will be valuation of the company also changes. At the same time, foreign currency fluctuations are there, the valuation also affected because of this reason. Any price differential in DR and corresponding value of the Indian equity in domestic market leads to arbitrage opportunity. If the arbitrage is significant and beyond the transaction cost of converting DR into domestic equity and vice versa, investor would enjoy the arbitrage. Prior to 2009, the government of India only allowed the DR to be converted into domestic equity or underlying domestic shares and not the other way around. So, one way fungibility was there, and because of one way fungibility, the foreigners were getting the benefit of the arbitrage opportunity. After 2009, government of India realized this, and the two way fungibility they have created. So, two way fungibility means the domestic market, domestic investor can purchase ADR, GDR. At the same time, abroad market, the DR can also purchase, the foreign investor can also purchase and sell domestic company ADR, domestic company equity. So, two way fungibility reduce the arbitrage opportunity. Okay. These are because now two way fungibility is there, any valuation change, I suppose Infosys share more price in domestic market, then the Infosys share listed in Nasdaq investor will purchase DR and convert into equity and domestic equity of Infosys and get the value. Suppose DR is highly priced than domestic equity, then Indian investor will purchase DR and convert it into domestic equity and get the benefit. So, two way fungibility has reduced the opportunity of arbitrage, and valuation of investor perception over the period reduced significantly, and there may be real possibilities are there will be some arbitrage beyond the transaction cost. Because to understand the arbitrage opportunity, let us do a arbitrage problem in ICICI Bank equity shares. Here you can see ICICI Bank ADR is listed in NYSE, and the DR ratio is 1:2. As on February 12, 2013, the NSE market ICICI Bank share price hovering around 1140.95 rupees, while at the ADR, while at the NYSE the ADR of ICICI Bank is hovering around 43.71 US dollar. The ADR and domestic equity transaction cost is 0.25 US dollar. Is there any arbitrage opportunity between ADR and domestic equity of ICICI Bank if the dollar rate is as on February 12 53.82 rupees. Here you have to understand that ICICI Bank domestic market ICICI Bank domestic equity, here you have to understand the date is February 12, 2013 and US dollar rate is 53.82 INR. Okay. This is the guideline for US domestic price. One ICICI Bank share is 1140.95 rupees. Okay. In ADR of ICICI Bank listed in NYS New York Stock Exchange and hovering around ADR price is US dollar 43.71 and DR ratio that is depository ratio, that is 1 ADR 1 equal to 2 ICICI Bank domestic shares, 2 ICICI Bank domestic shares. Now, 1140 rupees and conversion rate, the conversion fee, transaction cost, conversion rate or conversion fee is US dollar 0.25. Okay. If you convert, you have to pay a transaction cost of 0.25 US dollar. Now, is there an arbitrage opportunity given the exchange rate 53.82? What are you supposed to do? Now, first you assuming that there is arbitrage opportunity, what you will do now? Two equity shares of ICICI Bank is equivalent to 1 ADR, but ADR is running at 43.71. So, 43.71 you have to convert this ADR 43.71 into $1 price each for 53.82, then it is equivalent to, if you see that I convert it ICICI Bank equity price. So, 2 domestic equities, so you have to convert exchange rate 53. So, 1 ADR is equivalent to INR, and if you multiply this, it is coming around to 2352.47. 2352.47. Okay. Now, so 1 ADR is equivalent to 2352.47. Now, 2 domestic equity equal to 1 ADR, equal to 1 ADR. So, question is 2 domestic equity price will be how much? One price is 1140.95, 2 will be how much into 2. So, it will be in domestic market 2 equity shares of ICICI Bank, 2 equity shares of ICICI Bank equivalent to how much? 1, it will be, if you multiply 2 into 1140.95 is equal to, it is coming 2281.90, 2281.90, but the 2 equity shares of ICICI Bank equivalent to 1 ADR, but 1 ADR is equivalent to 23.52. Now, you see there is a clear difference these 2 price. So, but difference is how much? Difference is 2352.47 minus 2281.90. The difference is something around rupee equivalent transaction, the difference is something around 69.57. So, if you purchase Indian market, in India market you purchase ICICI Bank share, 2 ICICI Bank convert into ADR and sell in NYSE market, New York market, you get the benefit of 69.5 cents, but there is equivalent of transaction cost. Transaction cost is equivalent how much? Transaction cost is 95, 0.25 dollar into 53.82. So, transaction cost equivalent is 13 rupees, 13.45 rupees. Understand, if you minus 13.45 this from this 69.52 till you are getting the benefit of arbitrage opportunity, but this arbitrage opportunity available only for few seconds. So, few seconds you have to, the investor have to more vigil to get the arbitrage opportunity. You can see the answer here. Here ADR price is 43.71. So, ICICI Bank equity price is 1140 in domestic market, share ratio is 1 ADR at 2 domestic equity shares. So, exchange rate is 53.82 rupees on 12th March, 12th February. So, 1 ADR price will be, if you multiply 53.82 into 43.71, the 1 ADR price in domestic money INR price, INR will be 2352.45. However, 2 domestic equity price, if you multiply 1149.5 into 2, you will get 2281.90. So, that arbitrage opportunity is 69.57, that is price price differential between these two 69.57. If you convert domestic into ADR, then you will have to pay transaction cost of $0.25 US. The $0.25 US equivalent to 13.455 Indian rupee. If you multiply 0.25 into 53.82. So, now arbitrage profit is 69.57 minus this 13.45, arbitrage opportunity is 56.15. The references you can go through the references, these references I have mentioned here, and some question I have model question for you. What rules the depository play in issuance and maintenance of deposit receipt? Here you have to mention the rule of the depository institution. Second question is what are the main difference between sponsored and unsponsored deposit receipt, and why all Indian ADR JDRs are sponsored. Sponsored unsponsored, we have discussed sponsored and unsponsored ADR JDR. Here you have to mention what is the rule of the different rule of the company. In case of sponsored, the rule is more. In case of unsponsored, there is no rule of the domestic company. Third question, what is two-way fungibility and what are the benefit of having two-way fungibility? Two-way fungibility nothing but converting domestic share into ADR or JDR, at the same time converting the ADR JDR into domestic share price. The two-way fungibility reduce the arbitrage opportunity. We have discussed that, you can discuss the same thing. Thank you.